Welcome to session on basics of life insurance.
Let's understand the Indian insurance industry. We need to understand this by understanding evolution of Indian insurance industry. We would first begin with pre-liberalization stage. Pre-liberalization is marked by the following events. In 1818, the first life insurance company was formed and named as Oriental Life Insurance Company in Calcutta. In 1938, Insurance Act was formulated to protect the interest of insuring public. In 1956, government took a major step to nationalize life insurance sector in India. On 1st of September 1956, the life insurance industry got nationalized and the Life Insurance Corporation of India (LIC) was formed by merging 170 life insurance companies and 75 PF societies. In 1993, the Malhotra Committee was set up under the chairmanship of Mr. R. N. Malhotra to explore and recommend changes for development of the industry, including the reintroduction of an element of competition. The committee submitted its report in 1994, and as per its recommendations, the Insurance Regulatory Authority (IRA) was established in 1997. In the year 1999, Parliament passed the Insurance Regulatory and Development Act, 1999, IRDA, which led to the formation of Insurance Regulatory and Development Authority, IRDA. This is considered as the statutory regulatory body of the insurance industry. Financial year 2000 to 2001 is marked as the beginning of post-liberalization phase, where insurance sector was open to private insurance companies. Foreign companies were allowed to participate in insurance business in India through joint ventures with Indian insurance companies. Since then, many reforms got introduced from time to time. Few of the recent reforms are: in 2014, IRDA is renamed as IRDAI. In 2016, the FDI limit got raised to the maximum of 49% from 26% in the same year. The insurance companies were granted the permission to listed on NSE and BSE. Life insurance industry holds second place, next to banking, in mobilized savings in India. Life insurance companies contribute significantly to the development of economy by providing direct employment to 2.78 lakh people. Besides this, another 21.37 lakh people are associated as agents. Industry is managing financial assets worth 35.62 lakh crore rupees. Industry manages 32.52 crore in force policies in India. There are 24 life insurance companies operating in India. It's time to understand the basics of life insurance. Let me start with a story. There were 10 farmers living in a small village. After every crop season, farmers used to sell their harvest to nearby market. This was the only source of earning for these farmers. Every season, some crops used to get damaged. As a result, farmers had to incur losses. One day, they decided to go to village priest for guidance. After listening to farmers, priest asked them to first quantify their losses. In monetary terms, he advised them to pool in money to create a fund, so that whosoever incurs losses can be compensated accordingly. Let us assume monetary loss amounts to 5,000 rupees, and there are 10 farmers. This means each farmer have to contribute 500 rupees for creating the fund, and in case of any crop damage, farmers can be compensated with this fund. In this way, priest offered a solution for compensating the losses. Insurance is an arrangement by which you pay money to an insurance company, and they provide financial protection for your property, life or health, paying you in case of loss or damage. Let's understand, how does life insurance benefits the customer? This is the story of Mr. Raj. Raj's family comprises of his wife Aarti, a homemaker, son Pranav, a student of Standard 3, father Jagdish, and mother Jaya. Raj is the only earning member of the family. His earnings fulfill the basic needs like household expenses, expenses related to his son's education, medical expenses for his parents, and provisions for the future needs. If something happens to Raj, and the earning stops, his family will face challenges in meeting their regular expenses, and all their future plans and dreams will get shattered. If Raj had adequately ensured, his family would get financial compensation, and they can maintain the same standard of living. Let's understand what is risk. Risk refers to a situation where the probability of an event is known, but mode, or timing, or actual value of occurrence is not known. From life insurance point of view, risk refers to the likelihood that an insured event will occur, requiring the insurer to pay a claim. In context of life insurance, cause of risk are untimely death, disability, prolonged illness, and destitution, that is, retirement. There are three components of risk, namely, level of risk, uncertainty, peril and hazard. Let us understand these components one by one. Level of risk depends on frequency of the event and its severity. It helps in assessment of risk. Uncertainty. Insurance is available only for risks that are uncertain. Death is certain, its timing is uncertain. A peril is something that can cause a loss. Some of the common examples include crashing your car, fire, wind, hail, lightning, water, volcanic eruptions, choking, or falling objects. A hazard is any condition or situation that makes it more likely that a peril will occur. In Kerala, abnormally high rainfall raised the water levels of different water bodies. Overflow in the water bodies caused floods in the plains. Rising water levels caused waterlogging, which lead to immense loss of life and property all across the state. Here in this situation, rainfall becomes the peril, flooding becomes the hazard, and loss of life or property becomes the risk. We have understood that hazards are the factors affecting the risk on life. There are three types of hazards. Physical hazard. The physical hazard is a physical condition that increases the possibility of loss. For example, overweight, smoking, or any pre-existing disease. Occupational hazard. Danger to life that is inherent or is associated with particular occupation, industry or work environment. Technicians working on high-tension lines, truck driver, army or paramilitary personnel in the war zone are prone to hazards related to their profession, and hence the disclosure to the insurance company becomes very important. Moral hazard is a situation in where one party gets involved in a risky event, knowing that the other party will incur the cost. It is a situation where both the parties have incomplete information. Moral hazard is linked to the attitude of the person. For example, a person working as a technician on high-tension power transmission lines at the time of taking insurance does not want to disclose it. Now, risks associated with such profile are different from the risks associated with a normal electrician. This is a case of moral hazard, as the person willfully did not disclose the information. Life insurance on one way covers risk of dying too young, while on the other way, it also covers risk of living too long. Considering the risk of dying too young, the concerns are family lifestyle protection, money for financial needs, injury or prolonged illness, and loans or liabilities. While we talk about risk of living too long, the major concerns are retirement and succession planning, injury or prolonged illness, and wealth accumulation. Life insurance helps you in addressing all these concerns efficiently. Let us understand what is a contract. A contract is an agreement between two or more parties to do or not to do something. A contract is valid only if it is enforceable by law. A contract can be enforceable by law if it has following essentials of valid contract. Parties to a contract. Offerer is the party who offers the contract, while offeree is the party accepting the contract. Offer and acceptance. One party has to offer, and the other has to accept. Free consent. A consent is said to be free when it is not caused by coercion or undue influence, or fraud or misrepresentation, or mistake. Lawful consideration. The consideration, or object of an agreement, is lawful, unless and until it is forbidden by law. Lawful objective. The object of agreement must be lawful. Let us understand, with the help of this example. Seema bought a pencil box from Ambika Stationers. Is this a valid contract? Let us examine. In this situation, there are two distinct parties, Seema and Ambika Stationers. Seema offered to purchase, and Ambika Stationers agreed to sell. Both parties completed this transaction with consent and without coercion. Seema paid the price of pencil box, which is lawful consideration. Buying pencil box is a lawful objective. Hence we can conclude that it is a valid contract. Let us find out whether insurance is a legal contract or not. In insurance, the parties are the person who wants to be insured, and the insurance company. The individual offers, and the insurance company accepts the offer. There is no pressure from the individual to the insurance company to accept the offer. Neither insurer can exert any pressure. The consideration is premium in case of insurance. Insurance is a promise to pay in case of a peril. It is a unique type of contract between the life assured customer and the insurer company. Therefore, we can conclude that insurance is a legal contract. Let's talk about the principles of life insurance. Business of life insurance works on two basic principles. They are principle of utmost good faith and principle of insurable interest. Principle of utmost good faith is required throughout the contract, while principle of insurable interest is required only at the time of entering the contract, that is, policy inception. Insurance is a special type of contract, since the subject is intangible and cannot be easily known through direct observation or experience by the insurer. Also, there are many facts, because of their very nature, may be known only to the proposer. Utmost good faith is a principle used in life insurance contract that legally obliges all parties to reveal to others all important information. The doctrine of utmost good faith is known as Uberrima fides. Let us identify the meaning of material facts. Material facts are those which are important for assessment of risk, and hence should be mentioned clearly. Material facts include smoking, drinking alcohol, pre-existing diseases, existing insurance policy details, and family health details, like at what age parents died, and their cause of death, etc. Let us take the case of Rajiv, who is suffering from high blood pressure. He takes medicines to keep it under control. This affects his life expectancy, and hence is a material fact for the insurer, and proper disclosure of this information is essential while filling up the proposal form. In case, if Rajiv does not disclose this medical condition to insurer, it is called non-disclosure of material fact. As per the provisions of Section 45 of Insurance Act, if material facts are discovered within 2 years of the policy commencement, then the insurer can declare the policy as null and void. Also, the policy cannot be called in question after 2 years on the grounds of inaccurate or false statement unless it is proved to be material and fraudulent. We can say that Section 45 upholds the benefits of both the customer and the life insurance company. I would like to explain another about principle, that is, principle of insurable interest. Insurable interest exists when a person derives a financial or other kind of benefit from the existence of another insured person. This is one of the essential component of every insurance contract, which makes it a contract legal. Let us understand this with the help of example of Mr. Ajay. Ajay is insured with one of the life insurance company, and he dies due to an accident. His wife or children, parents, are likely to suffer financially from his death, as he was the bread earner for his family. As per the insurance contract, they have an insurable interest. A person has insurable interest on his own life, spouse, and minor children. Insurable interest also exists in other cases, like business partners, creditors and debtors, employer and employee, have insurable interest on one another. Let us understand how insurance works in practical life. The proposer applies for a new policy. The insurer promises to pay the claim on the occurrence of the insured event. The proposer pays premium. Insurer underwrites and accepts the policy. This completes an insurance contract. Before moving further, let us understand a few common terminologies. Premium. It refers to the amount one must pay for an insurance policy. Proposer is the person who purchases the policy and pays the premium. Insured is the person whose life is being insured. If this person dies, it triggers the death benefit payout. The insured may or may not be the same person as the policy owner. Sum assured is the guaranteed amount the policyholder will receive. This is also known as the cover or the coverage amount, and is the total amount for which an individual is insured. Policy term. It refers to the duration of the policy. Premium payment term. It is the total number of years for the policyholder to pay the premium. Typically, the insurance policies have regular premium payment, which means payment term equals to policy term. Single premium payment, which means premiums are to be paid in lump sum at the inception of policy. Limited premium payment, which means specified number of years premiums needs to be paid. Grace period refers to the additional time given to the policyholder to pay the premiums after the due date. Policyholders get a 31 days grace period if their policies are in yearly or half-yearly or quarterly modes. For monthly mode policies, the grace period is reduced to 15 days. The premium, however, remains due, and if the policyholder dies during this period, the insurer may deduct the premium from the death benefit. If premiums remain unpaid, even after the grace period is over, the policy would then be considered lapsed. Lapsation. A policy may be said to be in lapse condition if premium has not been paid, even during the days of grace. Free look cancellation. The policy owner has the option to withdraw from the contract within 15 days of the issue of the policy. He will be refunded the premium paid, less cost of risk for the short period, and expenses towards medical examination and stamp duty. Surrender. Indian Insurance Act allows the policyholders to voluntarily terminate their insurance policy in case if they are not in a position to pay premiums. It also allows for accrual of certain benefits to policyholders, as policyholder has a claim to the cash value accumulated under the policy. Any life insurance policy where the premiums has been paid for at least 3 consecutive years is entitled for a guaranteed surrender. Proposal form. It is the form completed by the policyholder while applying for insurance. It contains all the details necessary for insurance contract. Policy document. It is the most important document associated with insurance. It is the evidence of insurance contract. It contains all the necessary details of the contract. The standard policy document typically has 3 parts, which are the policy schedule, standard provisions, and the policy's specific provisions. Documentation contains proposer's statutory documents pertaining to AML and KYC norms, financial status, and medical status. First premium receipt, FPR. An insurance contract commences when the life insurance company issues a first premium receipt, FPR. The FPR is the evidence that the policy contract has begun. Nomination is where the life assured proposes the name of the persons to whom the sum assured should be paid by the insurance company after their death. Section 39 of Insurance Act, 1938, and Insurance Amendment Act 2015 defines the process of nomination. The assignment of a life insurance policy implies the act of transferring the rights, title and interest in the policy as property from one person to another. Assignment can be either absolute or conditional. Section 38 of Insurance Act, 1938 defines the process of assignment. Now let's talk about a very important process in insurance business. We are referring to underwriting. Underwriting is the process of risk assessment. The objective of underwriting is to ensure that cost of cover is proportionate to the risks faced by the individual. Judgment method or numerical method is widely used for underwriting insurance proposals. Underwriting can either medical, non-medical, or financial. Medical underwriting is done to evaluate the risk associated with the life to be insured on medical grounds. It is the process of evaluation of life risk in terms of medical or health and is based on family history, personal history, heredity, and medical reports. Non-medical underwriting doesn't involve any health checkups for the life to be in order to provide the risk cover. It is the process of evaluation of risk on the basis of other physical and environmental factors the life assured is associated with, like age, sum assured, and moral hazard. Financial underwriting is the process of assessment of life to be assured on the basis of his or her financial conditions. It has two aspects: source of income and amount of insurance. Source of income should be legitimate, and the proposer should have the capacity to pay the premiums. Amount of insurance should be such that the total insurance should be in proportion to the annual income. Normally, as a thumb rule, a healthy person can take insurance cover up to 20 times of his or her annual income. After understanding the underwriting process, you would understand the various underwriting decisions. There are 5 basic underwriting decisions. Let us understand each one of these. Acceptance at ordinary rates means the risk is accepted at the same rate of premium. Acceptance with an extra premium means some extra premiums required to be paid to accept the risk. Acceptance with a lien on sum assured. A lien is a kind of hold which the life insurance company can exercise, in part or whole, on the amount of benefit it has to pay in the event of a claim. For example, it may be imposed in case the life proposed for insurance has suffered and recovered from certain disease, like TB. Lien implies that if the life assured dies from a specified cause, for example relapse of the TB, within a given period, only a decreased amount of death benefit may be payable. Acceptance with a restrictive clause. For certain kinds of hazards, a restrictive clause may be applied which limits death benefit in the event of death under certain circumstances. For example, there is a pregnancy clause imposed on pregnant ladies that limits insurance payable in the event of pregnancy-related deaths occurring within, say, 3 months of delivery. Decline or postpone. This would happen when there are certain health or other features which are highly adverse. Agent Confidential Report, or ACR, is declaration by Life Mitra, or CIF. The Life Mitra, or CIF, has to inform the insurer about the factors that affect the risk of the subject matter of insurance. The Life Mitra, or CIF, has to make sure of this by submitting the unambiguous report, and also by ensuring that proposal papers do not conceal information. ICR is the source of data for the underwriter. This is an obligation that the Life Mitra, or CIF, owes to the insurer. This report is essential for avoiding. A rider is a provision, typically added through an endorsement, which then becomes part of the contract. Riders are commonly used to provide some sort of supplementary benefit, or to increase the amount of death benefit provided by a policy. Riders can be compared to choice of different toppings in a pizza. A base policy is like a pizza base, and choice of riders is like choice of different pizza toppings, available to customize the pizza as per an individual's requirement. Riders help to customize different requirements of a person into a single plan. It is also important to note that the premium related to all the riders put together should not exceed 30% of the premium of the main product. Let's understand claims in life insurance. A claim is a demand that the insurer should make good the promise specified in the contract. A claim under a life insurance contract is triggered by the happening of one or more of the events covered under the insurance contract. While in some claims, the contract continues. In others, the contract is terminated. Claims are of two types: survival claims and death claims. Survival claims, payable even when the life assured is alive, and death claim, while a death claim arises only upon the death of the life assured. Survival claims can be caused by one or more events. Events triggering survival claims are: 1. Maturity of the policy. 2. Survival benefits payable on reaching a particular milestone under a money-back policy. 3. Surrender of the policy. 4. Special provisions, like partial withdrawals. 5. Rider benefits. After understanding the various principles and processes, let's get familiarized with insurance products. Insurance products are categorized as traditional and non-traditional insurance products. Traditional insurance products include term insurance, whole life insurance, and endowment assurance products. A term life insurance fulfills the main and basic idea behind life insurance. That is, if life insured dies prematurely, there will be a sum of money available to take care of his or her family. All premiums received under such a policy may be treated as earned towards the cost of mortality risk by the company. There is no savings or accrued cash value element for the insured. This means that term insurance plan does neither have any maturity nor surrender value. Whole life plans. Whole life plans are designed to remain in force until the death of the insured, and hence premiums in this case are much higher than term premiums. Endowment assurance. An endowment assurance contract is actually a combination of two plans. 1. A term assurance plan, which pays the full sum assured in case of death of the insured during the term. 2. A pure endowment plan, which pays this amount if the insured survives at the end of the term. The product thus has both death as well as a survival benefits. Non-traditional products include variable insurance and unit-linked insurance. Variable insurance, variable life insurance, is a kind of policy where the death benefit and cash value of the policy fluctuates according to the investment performance of a special investment account into which premiums are credited. The benefits under unit-linked insurance contracts are wholly or partially determined by the value of units credited to the policyholder's account at the date when payment is due. Insurance. Now it is important to understand the different life stages and the need for life insurance at respective life stages. Why do people buy insurance? People buy insurance first to protect themselves against any financial losses arising due to any unforeseen events like death. Insurance products are also bought for investments or savings to take care of any future financial needs at different life stages of an individual. The next question is, what does income pay for? Income pays for your food and clothes, household bills, education of children, repayment of loans, mortgage or rent, social events. In short, income pays for your immediate livelihood. Besides this, income also provides future savings. Now it is also important to understand, why do people save for? People save for their children's education, children's marriage, buying or upgrading house, your retirement, holidays, loans repayment, and meeting any contingencies and emergencies. Let's understand why protection is required. People need financial protection against the possibility, risk, of loss or reduced income earning capacity, or reduced future savings. People have different financial goals across different life stages. First, let us understand the different life stages. First stage is called as earner. Earner is in the age 20 to 25 years. In this stage, person has either started earning recently or just settled in his job. At this stage, generally expenses are lower than the income. Awareness and need for financial protection is quite low. Second stage is called as partner. Partner is in the age 25 to 30 year. This stage includes newly or recently married people. At this stage, there is an increase in income as well as expenses, though people start some savings, but inclination towards financial planning is very low. Third stage is called as parent. At this stage, the person is in the age 30 to 55 year. They have a children, take care of their parents. At this stage, increase in expenses are more than increase in income. As the family responsibilities increase, people become more and more serious towards savings and financial planning. Fourth stage is retiree. Person at this stage is well settled, have grown-up children. They save either for their children or for wealth creation to ensure financial security post-retirement. Life insurance is an effective tool for protection of income and future savings, suitable for all stages of life. Let us explain the need for life insurance with the help of an example of a money machine. Imagine you have a money machine in your house. The machine dispenses money as and when required. Would you like to insure the machine to guarantee that if something happened to the machine, the money will be there as and when as required? Certainly yes. You also work like a money machine for yourself and your family by generating income. Imagine what would happen to your family if something goes wrong with this machine. Hence, we can conclude that life insurance is the most effective tool to take care of financial losses due to such uncertainties. You can use life insurance to provide income to survivors, as an emergency fund, for mortgage cancellation, for debt liquidation, to create an estate, for charitable donations, for retirement funding, for vacation funding, funding for children's education and marriages, to provide employee benefits, and to protect a business from financial loss, etc.